Alright, in this video I'm going to be discussing the solution to practice problem number 3, which is about the exchange of assets lacking commercial substance. So here's the problem. We see Arden is going to exchange some machinery with Campbell. Important in this problem, it says here the new machinery is expected to generate the same future cash flows as the old machinery. That's a giveaway that the exchange lacks commercial substance, and so if there's any gain to be recognized, they're only going to be allowed to recognize the gain up to the point of the cash that is received, or in proportion to the cash that is received. So that's something to keep in mind. So let's take a look at the solution for Arden. We're going to need to prepare journal entries for both Arden and Campbell. So Arden, the easy pieces of this journal entry, they need to take off their old machine from their books. So that's right here. They're going to credit machinery for $100,000. They're going to debit accumulated depreciation for $40,000 to take off the old accumulated depreciation from their books. Again, that's given up here in the problem. You're told that Arden also pays cash of $10,000. So Arden is going to credit cash $10,000. Now, to calculate whether there was a gain or a loss on the equipment, we're going to look at the fair value of the old equipment minus the book value of the old equipment. Right, and so we're told the fair value of the old machinery is $75,000. The book value of the old machinery, 100 minus 40, is $60,000. So there is a $15,000 gain that would be recognized on this transaction if the transaction had commercial substance. But it does not, so we're not allowed to recognize any of that gain. Right, and so the value of the new machinery on Arden's books ends up being equal to the book value of the old machinery plus the cash that was paid. Right, there was no cash received, no gain recognized. So the book value of the old was 60, the cash that was paid was 10, and so we get a debit to the new machinery for $70,000. All right, and that's the entire journal entry for Arden. For Campbell, now this is what their journal entry looks like. Right, I guess this part right here is their journal entry, and the easier parts of the journal entry, we're told that the book value of Campbell's new machine is $64,000. So we weren't told what the depreciation and the value of the machinery was separately, but we need to take off that book value of $64,000. Some of that is going to be depreciation, some of it is going to be the cost of the machine. In this problem, we weren't told separately the cost and the accumulated depreciation, so we'll just credit the entire book value to the machinery account to remove that from Campbell's books. Campbell then received $10,000 cash, so we need to debit cash for $10,000. Alright, and then the other two pieces of this journal entry look a little bit odd. A gain of $24.71 and machinery of $56,471. And so let's talk about how we get those. First, we need to calculate the total gain on the transaction for Campbell, assuming that the transaction had commercial substance. And again, that's going to be fair value of old minus book value of old. Right, we know the book value of the old machine is $64,000. We weren't told the fair value of the old machine, but we do know that the fair value given equals the fair value received. Right, and so the fair value received was a machine that had a fair value of $75,000 plus $10,000 in cash. The only thing that was given was the old machine, and so its fair value must be $85,000. Right, and that's what we're figuring out down here. So now we can plug that into the gain equation, and we get a gain of $21,000 if there was commercial substance. And we see that here in this line. There's not commercial substance though, so they're not allowed to recognize the entire gain. However, they did receive some cash. Right? They received $10,000, and so what they are allowed to recognize in terms of a gain is the proportion of the total gain that is related to the cash that they received. So that's the cash that they received divided by the total fair value of what they received. So they received $10,000 in cash. The total fair value of everything they received was $85,000. The $10,000 in cash plus the $75,000 of the machine. So this percentage here, 10,000 over 85,000, is the percentage of the total gain that they'll be allowed to recognize in this transaction. Take that percentage times the total gain of 21,000, and that is how I get the $2,471, which gets credited to gain on exchange in the transaction. Alright, from there, the value of the new machinery is going to be the book value of the old plus cash paid minus cash received plus gain recognized minus loss recognized. And so the book value of the old was $64,000. We didn't pay any cash. We received $10,000 in cash. We recorded a gain of $2,471, and we recorded no loss. And so the book value of the new machine at the beginning of this exchange is going to be $56,471, which gets debited to the new machinery account. And that is the entire journal entry for Campbell.